So we will start with Ron Miller, who's the co-founder of Start Engine, which is one of the top premier sites to actually launch your Regulation 8 Plus raise on.
Great. So thank you. It's great to be here. My name is Ron Miller. I'm the CEO of Start Engine. We're one of the portals that basically serves as a digital marketplace to connect investors directly with entrepreneurs seeking to raise capital in the Reg A and Reg CF space. And we can go into a little bit more detail about what that is if you'd like down the line.
Sure. And then we have Gene Massey, who has a company called Media Shares. He's raising money on Start Engine at the moment, and he also can talk about some of the marketing aspects of raising money through these modes of fundraising.
Actually, we're not raising on Start Engine, Media Shares is a consulting firm for many years, and we are planning on being an issuer at some point. We own game shares, racing shares, music shares, Broadway shares, celebrity shares, derby shares, and Media Shares wants to be a conglomerate of doing a Reg A at some point where we will fund those types of enterprises and everything that's fan-focused. But for many years now, we've been a marketing firm and a consulting firm helping others do crowdfunding campaigns. Gene Massey, Media Shares.
And then Jillian Sidoti's been is an attorney in this space, and she's been at it for quite a while. So,
hi, I'm Jillian Sidoti. Our website is crowdfundinglawyers.net, and we've been doing offerings for film, real estate, and now in the cannabis space, from Reg A to small little offerings under 506.
Great. And finally from New York, Joshua Sessler, who is a partner at Cowan, DeBars, Abrams, and Shepard.
That's close. That's good.
Too many names.
You know law firms with a lot of names. Josh Sessler, we're an entertainment firm based in New York and in Beverly Hills. Always like to come out here and visit our Beverly Hills office, although the weather in New York is just like this, hot in the 80s. But I've been practicing in the entertainment, digital media, and technology space for about 15 years and rode the whole internet bubble and seen different forms of fundraising from my own companies to big IPOs and corporate law firms in New York. And it's an exciting time, and I'm happy to be on the panel and be able to discuss where we are and field your questions.
And so, by the show of hands, would you say you understand the difference between incentive-based crowdfunding and equity-based crowdfunding? If you do, you can raise your hand. All right, so I think we're gonna explain it. So maybe, Ron, would you like to kind of explain the difference between the two and why you started Start Engine?
Sure. So probably the best way to explain the difference is by telling the story of Oculus Rift. Oculus was a VR headset hardware company, basically, and they raised approximately $2.2 million on Kickstarter. Now, at that rate, it's one of the most successful raises in Kickstarter history. The average on Kickstarter, I think, is something in the teens, like 15, 16, 18,000 is the average raise on Kickstarter. So if that's your budget, that's a good direction to head if you're looking to raise that kind of money. They raised $2.2 million. After having done so, what they did ultimately was, even prior to shipping the product to the people who had backed it with that $2.2 million, they got acquired by Facebook for $2.2 billion. So people are thinking they made 100 times on their money. So when they went back to Oculus and said, hey, Oculus, so where's our piece of this? The answer is you don't get any. And the reason why is because if you're investing in what's called a rewards or donation-based crowdfunding, you're simply making a gift as a backer because you're interested and motivated to see somebody's dream come to life. And that's really what you get back, in addition to, of course, maybe your t-shirt or an early copy of a media product. But that's pretty much it. And of course, as the company goes down the line, there are no expectation of a return and no actual return. So again, it wasn't the folks at Kickstarter that sort of made up that scheme, and it certainly wasn't the Oculus people. It was actually illegal to do it at that time. But yet that, I think, points out maybe the greatest difference between the two. I would say, generally speaking, the average raise in the teens. The overall success rate on Kickstarter is, I think, in the high 20% The average raise currently on Reg CF is in the many hundreds of thousands. I think it's currently 300,000 or 400,000 is the average raise on a Reg CF raise. So those are some of the differences. There's probably more.
That's really, that kind of outlines the basic, the two differences. Now, in terms of the types of companies that you're seeing raise this kind of money, and maybe I'll ask Jillian to start with this because she's been doing it for a while. What are some of the top, I would say, deal types that you're seeing do crowdfunding raises?
Well, the biggest ones I'm seeing, of course, are real estate, and I think most of the crowdfunding platforms are real estate focused. If I have anything that's not real estate focused, I send it to Ron, to be perfectly honest. I try to get that kind of stuff listed on Ron's website. And there's a couple of other, there's a lot of medical tech type smaller raises that are happening on sites like WeFunder and equity.com, but really the overwhelming majority of offerings are real estate related offerings. And that's what I'm really seeing out there. And it's a great way for real estate entrepreneurs who were kind of trying to buy an apartment building and couldn't get enough money from friends and family to now go out and say, well, now I have this real estate fund. I'm going to buy several pieces of real estate, and anybody can invest in that. And so that's really who's moving on.
And I maybe now we can define the different tiers and then different amounts you can raise with each, because
Absolutely.
real estate is usually tier 1.
No, actually, you could do tier 1. You can do tier 1 with anything. You can raise up to $20 million with tier 1, and you can raise up to $50 million with tier 2 under Regulation A. But I will say this. If somebody comes to me and says to me, I want to do a tier 1, I 9 times out of 10 will either turn them away or I will convince them to do a tier 2. And here's why. It's going to cost them more money and time to get approval from the states than it will for them to get an audit done and get it fully approved by the SEC. So that's the difference between tier 1 and tier 2. So tier 1 is $20 million, no audit required, but you have to get it approved by every state where you want to raise money. Converse to that is tier 2, $50 million, audit required, no approval from the states. And I actually want to ask Ron, do you take any tier 1s, Ron, or do
No.
you see?
And,
Okay, there.
Yeah,
Good. I feel validated now.
You and I, absolutely. No, we think alike. It doesn't really exist. I mean, they're in theory,
Yeah.
but it's
Well,
not.
for
I
real
don't think-
estate, if you have 1 or 2 states,
I
think.
suppose.
Yeah, I do have, and that is such a great point, Mariana, because I have one client who came to me and just dug his heels in and said, I do not want to do an audit. I think it's a waste of my time. I can't do it every year. I'm going to have too much volume to justify the cost of the audit, and I'm only going to exist in Colorado and Minnesota. So you're absolutely right.
So, and those are a little easier to approve if you just have, limited amount of
Exactly.
states. But we tried doing a tier 1 with one of my companies, and we switched over to tier 2, 3 months into it. Even though we had an SEC approval, getting the states was just impossible.
Well, it's so funny because prior to the Jobs Act, I had a client who was out of Texas, and everything was tier 1 before the Jobs Act. And so he was out of Texas, and we had this beautiful offering that had been approved by the SEC. I got it approved by like 3 different states, and then when he took it to the state of Texas, they asked for so much, it literally killed the deal right then and there.
That's
for him.
insane.
Yeah.
In terms of, so now if you're in the audience here raising money, then we're left with really 2 choices. So a year and a half ago, we got the Regulation A+, so you can file with the SEC and raise up to $50 million each year after year with the same filing. And then a few months ago, they approved the regulations of crowdfunding, and that one will allow you to raise up to $1 million each year after year with that one filing. Now, Ron, in terms of, you've done both now on Start Engine, you support both. What are you seeing in terms of the amount of deals that are coming through as Regulation A+ and the stage of those deals versus the deals that you're seeing as Regulation Crowdfunding and then the stage of those deals?
Well, again, I think it's driven in large part by the size of the community that the individual entrepreneur or company that wants to raise the capital has. In other words, if it's a massive one, meaning it's a known brand or known product, or has possibly even, in the context of digital Hollywood, known celebrities with it that have extensive social media footprints, I think those guys might take off and go right after a Reg A Plus raise right out of the gate. Again, that's more than $1 million. It's simpler, easier, and faster to launch your raise under the Reg CF, the one that lets you raise up to $1 million a year. So usually what we think in our study of what's worked best is start off with the Reg CF raise up to $1 million, because again, cheaper, easier, quicker, get started, and then come back and raise another round. Very similar to the way, maybe not so much in media, but in most businesses, when you raise capital, it's done a tranche at a time. You don't raise all that you need to get to break even right at the forefront. Not even great companies, Google, Facebook, Dropbox, those guys raise rounds. So there's nothing wrong with raising $1 million a year. And so that's something we're suggesting, is at least start with the Reg A Plus raise and then roll it into the Reg A Plus.
No, start with the Reg CF.
Well, I'm sorry, with Reg CF. I'm sorry. Yes, thank you for
And we should
pointing
also
that out.
point out that one of the features is being able to test the waters and not do a full on registration, but see if you can garner enough interest, and that's a great feature.
So explain the test the waters. I think that's important.
Well, as long as you are disclosing that this is not a real offering and that you are not taking any money, you can go out and get a kind of a gain interest litmus test to see if you're going to be able to raise the money that you're looking for. And if you're not, you can withdraw and not have to actually do the filings and do the accounting, and actually it still costs money, but it's not as expensive as going full out for a raise.
So that's an interesting point, because when we were thinking about this, the founder of the company I was working with at the time just was adamant about not testing the waters. He really was worried about testing the water. And the filing was really not that expensive and not that labor intensive. But I would say if you're not going the way that Ron described, like Regulation CF, you file for $1 million a year, you kind of bootstrap your way into a bigger raise. If you're just doing Reg A Plus, you may want to test the waters, because that's $250,000 to $500,000 upfront costs, and we're going to talk about these, like how they add up to that and where they should be. But that's a lot of cost, and you may want to figure it out up front if this is something that it's going to resonate even with your phone.
We know of a company that's doing a CF right now, and the $1 million that they got, they're using for their Reg A.
Yeah,
And that's generally the way
which
you
is
go.
what I think what Ron suggested.
Yeah.
That makes sense to
Yeah.
me too.
A plus a mini IPO. And so many companies wish that they had that test the waters capability in an IPO. I worked with a big company in the 90s, actually it was MTV, trying to put all their digital products out to the market, public market. And it was in 2000, the market dropped, and they had spent millions and millions of dollars, and they just withdrew. So it's good to be able to do that.
So let's look at the actual costs associated with regulation crowdfunding and with Regulation A+. So Jean, you want to kind of outline what some of the marketing costs associated with these two filings look like?
It depends on the size of your crowd that you can access before you begin. You would need to look at, I know from talking to the people at Start Engine, if you want to do an offering on Start Engine, they're very, very efficient about determining the size of your market before you file. And the worst thing that a platform, whether it's Start Engine or WeFunder or Seed Invest, the worst thing they want is a home page with a bunch of people on there that have all got 40 or 50 bucks. Got a very unsuccessful. That's the last thing, because it hurts the platform. You look at the platform and say, geez, none of these people are getting any money. I'm going to not waste my time either. So a really great platform like Start Engine will require you to show them how you are going to sell your offering. Show me the size of your crowd. They've even got a special grant for $50,000 in marketing. If you can show them that you're really, really good at what you're doing, they will actually help you with your marketing and actually pay some of your marketing bills. Am I right about that?
That is correct.
So that start engine, and it's a fabulous program.
Something you mentioned, the 50,000, something there, now what was that name again?
Imagine a platform that helps you by giving you $50,000 for your marketing enterprise. Well, they only want to do that if it looks like you're going to be successful. So they want to know, let's see, how many Facebook people do you have? What's the size of your YouTube crowd? They want to see all the social media facts and figures based on what you have. And so to answer your question, if you have all of that, you can practically do your offering with what you already have. If you're a celebrity, if you're Ashton Kutcher or somebody, and you've got millions of Twitter followers, you can do a pretty successul offering fairly easy. If you've got an idea, and the only person you know with any money is your Uncle Charlie, you've got to go to your Uncle Charlie and try to get some seed money from him, because you've got to have a social media presence that's incredible before you even begin. You have to, or really know, or have a story that's just so fabulous that the press is going to pick up on it. Oh my goodness, these guys have got a cure for cancer, and you just take a pill and the cancer goes away. You have to have some sort of story that's so fabulous that all the bloggers and all the press and the Wall Street Journal, everybody's going to pick up on it. If you have that, a story like that, it's not as expensive. If you have an idea that everybody goes, well, I don't know, and you don't have a crowd, it's tough.
So in terms of the actual cost, I want to put some dollar figures out there so people get an idea. Yeah, I've seen for the Regulation A+, numbers in the $150,000 range, where it includes your media buys, your influencers, campaigns, and all that.
Lawyers,
have you seen
don't forget lawyers.
No, legal, I'm going to go separate. So marketing, just marketing. Have you seen something in a smaller budget, Ron, that's actually been successful?
Oh yeah, again, it depends on how many resources are internal to the company that are raising capital. In other words, if you don't need to hire outside social media people, if you don't need to hire outside PR people, and if you don't need to hire, people that can help you with sort of the strategizing around the campaign, then the costs are a lot less. I think the minimum that I've seen from an outside third-party agency is about $10,000, and what that includes is really creating the message, which, when you're doing this, the most important thing is that people get excited about the mission. And the mission is more than the product or the company. It's about how this is going to change the world for the better, or why the world is going to be better off as a result of this entrepreneurial dream, or in your case, a production-oriented dream coming to life. And that's the reason they invest. So I think that's the first step that's really important that these agencies will help work on. So we raised almost $17 million for a little car company, but his real story was about reviving the American dream. But not the American dream of 50 or 100 years ago, but the American dream of now. So that was what people were buying into, right? It's a lot like Donald Trump, for example.
Yes.
You guys are supposed to laugh. Thank you. Appreciate that.
On you.
Selling the dream. But anyway, but it's about inspiring the passion. So it's not, it's not so much about the product or the company, but rather it's about the dream. And so that's being able to communicate that. And you guys, that would be something that I would imagine most people in this audience or in this community either have access to or know how to do, because you guys are storytellers for the most part. So I think it starts there. That's step one. And then step two is to what I call produce the message. And, of course, you guys are in the business, so that means the video content and the written content that appears on the site. And then finally, the third step in the campaign is the distribution of the message. So that's traditional PR, it's social media, and paid media as well. All three of those things come together to drive the traffic to the platform, which tells the story. And at that point, the investor hopefully is persuaded or is excited enough about this dream or your dream becoming real that they'll actually invest. Average investment on our platform across all deals right now, about $1,400. The high average for that Elio Motors raise for that little car was about $2,600. And each issuer, each company that's raising capital on the platform can set the minimum. So most of them set minimums around $400 to $600 is on average. And then
That's
usually
really
the
low.
average investment is usually higher. It is low,
It's really
but
low.
even though those are the minimum set, we're still seeing the average, because there will be people that come through with 4 or 5, maybe 10,000. Again, they become more rare as they're bigger. But I can tell you, it was $16.9 million. I think there was only one $100,000 investor. I think there might have been 2 50s and a handful of 25s. The rest of it was made up of, $2,000, $3,000, $4,000 investments.
That's
And
interesting.
your average on that was 2,500. right?
Yeah, but just over 2,500, just under 2,600, right?
So in terms of the pricing, that's awesome. That really helps. I think a lot of people in this audience have heard the sort of general discussion on Reg A+. We're really kind of getting down to what would it really mean to you. So in terms of the legal and audit fees, Jillian, what are those now for Reg A+?
So our firm's a little different because we charge, we're small and mighty. We don't have huge overhead. And so we charge a lot less than some of the bigger firms. I just want to... You can go to crowdfundinglawyers.net. But I want to say that because I don't want what I'm about to say to be your average. You shop around for sure. So we charge a $50,000 flat fee, legally speaking. If you're a brand new company with no assets and no history, then you can get an audit for as little as $2,500. What I tell my clients...
That's financial audit.
Yeah, financial audit, yeah. And what I tell my clients is that, or somebody who comes to me and says, I want to do a Reg A, I have what I call, and I literally say this to them because it kind of shocks them. I say, we have to have a come to Jesus moment where and they go, well, what do you mean by that? I'm willing to write you a check for $50,000. I said, unless you have a marketing budget or a huge list, I don't even want to take your $50,000 to do the work because it doesn't do me any good to have you have a Reg A that falls flat on its face. So I tell everybody that they have to budget at least $75,000 all in, and that includes your legal fees, your audit fees, your transfer agent, and leaves a little tiny bit for marketing, and that little tiny bit for marketing has got to be backed up by a big list. So all of my Reg A's right now, and I have about 10 of them, all have some kind of story already written in, group of people who already want to invest, and it just happens that they were dealing with accredited investors and now they want to give an opportunity to the unaccredited investors who have been following them, and that's it. Or they say, yeah, I have a budget for marketing. That's it. Those are the two things.
And then Ron, how long does it take once you have all this lined up? How long does it take from contacting Start Engine to raising the round? What are some of the lengths of time?
On CF or Reg A?
Either. Let's go
So
with
probably on
both.
CF, I would say minimum 3 months up to 6, and I'd say on Reg A Plus, it would take probably 4 to launch to 8 or 9. We've seen them go as long as a year because you can leave them keep going, and as long as there's money that continues to come in, lots of the companies raising capital have chosen to keep them open.
So you only leave yours open for 8 to 9 months?
No, it's up to the individual
Oh,
company
okay,
raising
'cause-
capital.
Because I have some that stay open for an entire year.
Yeah,
Yeah,
and,
okay.
you can leave them on.
But then
Again, it's
can
up to
you-
each company and what they think is the best that fits with their project or.
So let's say you
company.
raise $5 million within the first 3 months, and you have a minimum of 5, but you want to go up to 10. Would you take that $5 million to operate the company, or do you have to wait until the
You
end of the term?
You can
can take
do closes along the way, as you can at a Reg CF. So even if you're going up to $1 million, you could actually have.
Take 100 grand.
The first draw after 50 or 100, and then do several successive draws.
Multiple closings.
Multiple closes. So this is really interesting. Now, when I talk to people, we come in sort of at the consulting banking side of this, just trying to glue all the pieces together. And Hambrick's in this space. They've been working in Reg A plus space, taking it to their public investors. Let's talk about why would a company want to do a Reg A plus if the company is trying to raise money right now and feels like it could be a good venture capital raise. Why would you do this instead?
I can tell you. If you're not an underwritten IPO, then if you're an underwritten IPO and you're going to be on NASDAQ, you're exempt from each rule in the states. If you're filing an S1 and you're going to go out to the states and you're going to go out with an IPO, then and you're not on an exchange, you're just a little small IPO, then you've got to deal with merit review of the states. If you're doing a Regulation A, you're exempt from that, and you don't have to talk to merit review for each state. That's a huge advantage.
And you don't need underwriters.
And you don't need an underwriter. Now, you can still have a syndicate of brokers that do what's called a best effort, and they will go out and try to sell your deal. And you can make a deal with 3 or 4 different brokers, and that's one of the things we do is introduce you to brokers. but you can actually go out to a syndicate of brokers, and they'll help you sell your deal in addition to your online offering, or in addition to being posted on a portal. You can also have a back end of different brokers helping to sell the deal.
So,
That's a huge
so your
advantage.
stock is going to be liquid no matter what, right? It's
Well, it doesn't
that's
have to
not
be. You can have
necessarily true.
a non-public offering where you're not listed on an exchange, and there are some REITs and things that are doing that, right? And
Also,
so,
most of them won't list on an exchange.
Right.
and so you can
That's-
choose if you want to, like Elio, the offering that they did for 16.9 million, they went and they listed on the OTC exchange. And so the shareholders have an option of liquidity being listed on an exchange. They can actually sell their shares on an exchange, but some choose not to do that.
So why would they go liquid, Ron? What are some companies you're seeing that actually go to the exchanges from Reg A+?
Really, Elio Motors is the first and only that's done it so far. And again, there were 6,300 unique investors in that. So but I'd say that one's an outlier. That's not the norm. But I think for the purpose of the audience, I think that to understand sort of what are the pluses and minuses. Why would you raise capital under either one of these rules, right? Why would you do it? Why wouldn't you do it? And my answer to why you would do it is, number one, you get to set the terms of the raise. If you guys have had an experience with financing stuff or you've read about it, what you'll learn is the people that have the money are going to set the terms. They're going to tell you what the value of the project or company is. They'll tell you what the value of each share. They'll tell you how many shares they want to buy, how they want to structure it, and importantly, they often put control hooks, things that will ultimately end up in a lot of entrepreneurs losing their companies because they don't meet the requirements of these control hooks. They put in board seats and all sorts of legal rights that at the beginning, when you get the money, people are happy to get the money, don't pay a lot of attention to it, but it's rare to find people that have raised capital from venture capitalists in particular that end up later saying, oh, that was the greatest thing I ever did, right? So that's an advantage. You get to set the terms, right? And keep control. So even Elio Motors raised almost 18 million. It's a brand new startup company. They valued it at 300 million. They only sold like 6% or something like that. So the majority of those, and the control was kept by Paul Elio, the guy that founded the company. So that's an advantage. The second advantage is you end up with an army of brand ambassadors. So again, going to the Elio case where there's 6,300 unique investors, each one of those people becomes very powerful in the form of social media, right? In the old days, it was traditional advertising, used to be effective, but now as traditional advertising is more expensive and less effective, social becomes king. Well, the question is, how do you control or harness the power of social? And my answer is, well, if these people are committed to your brand, they love you, they love your product, and they feel financially incentivized even, or they feel like they're part of you, they're affiliated with you, which is a much more kind of millennial thinking anyway. They want to be affiliated with the companies, connected to the companies that they do business with. So having that power, if each person has on average 1,000 people in their phone, each 6,300, that gives them a media reach of about 6,300,000 people. Now, look, not every one of those 6,300 is going to push the message, but even if half of them did, they have a reach of 3.5 million at a cost of zero. When they release the convertible model or the blue color or whatever they do, they get to engage that social network to begin furthering that. So those are the two advantages, is control the terms and your army. And on the negative side, one is that you become a public company. So this is disclosure. You have to disclose, and it's relatively simple mechanically how you do it. You just have to post the reports. You have to file these reports twice a year with the SEC, and they get posted on the investor relations section on your website. And even though you can password encrypt it, it's still accessible to your employees, your stakeholders, your distributors,
Competitors.
your providers. What's that? Competitors, absolutely. All they have to do is buy a share of stock. Guess what? They get access, and there's nothing you can do to stop them. They get access, of course, to the password that gives them the access to the public report that goes out each year. No, nobody needs to see the individual salaries, but they do need to see some pretty significant and important information that a lot of entrepreneurs just aren't comfortable. I'll put it that way.
It's funny you said that the password, because they don't even need to do that. They could just go to
Get
the
it on
SEC's website. Yeah.
That's true. That is true. If they
If
were
they knew
so
what they're
inclined and sophisticated, but an average employee may not be.
Right.
So, and then the final, the downside of this, it's hard work. I have a
It's not
company
cheap
raising
either.
capital on the platform. The guy took, 2 or 3 vacations over the 90-day period. One of them he was off the grid. And that is not what it's going to take to do this successfully, because what you're doing here is you're basically building your customer base and promoting to your customers at the same time you're raising capital. And if you think that's a part-time job, it's not. So what we've learned, among the factors we look at, like in this $50,000 incentive, we've learned focused founder is a critical element of success. So if the founder is, well, I'm working my day gig, and by the way, I'm going to do this on the side, we're not in, because that doesn't mean we won't put it on there. We might. But I think the chances of success go down a lot. So focus founder is key, because it's a lot of work, and you got to be ready to sort of, it's game on. And even anybody that's ever done a Kickstarter raise will tell you that you need to plan on being very focused on PR and social media. Every day you're posting on social media. Every day you're updating your investors, asking them who else they know or do they want to increase their investment. So there's just a lot of work in engaging these people and retelling the story and showing new product or new clips or doing a webcast with the team that's going to be creating this product or doing whatever it is you're doing. But that's the key to it. It doesn't happen. Biggest fallacy is that a lot of people with projects think that their project is so great that if I just show the world by placing it on any sort of portal, whether it's Kickstarter or whether it's a portal like ours that's an equity investment portal, they think there's just people out there that are looking for the next opportunity to put money into. And there's nothing further than the truth. Even
If I build it, they will come.
There you go. Yeah, you've heard this one before, I think. So Kickstarter's got about 10 million people in their community. But it is very, very well established that if you don't promote your raise, sure, there's 10 million people that are part of that community, but they're not coming and investing in your deal because they were on there, kind of trolling for the next investment opportunity. It's not how it works. People invested in Elio Motors because they love that little car. They were passionate. By the way, it's a little car, $6,800 retail price, 84 miles to the gallon, gasoline powered, seats 2. Front to back instead of side by side, half as much air. And the guy that's founding it is a really talented guy. But people are excited about this little car. And it's actually even, wealthy people that can afford to buy a BMW or Mercedes, everybody wants one of these things. So people, that's why they became investors. And in fact, even after it went live on the OTC, in order to be able to sell the shares, people had to take them from Elio and essentially transfer them into their brokerage account. Less than half of the people that invested even attempted to transfer. Why? Because they're excited about the company. They're not here to buy to sell the shares. That's not what they're doing. They're here because they're in for the long haul. And by the way, the shares sold on our platform at 12. They're currently trading about 20. And this was February of this year. So
I missed out.
What's that? You missed that? Oh, yeah, you missed out. You would have made 60%. How'd you do on your portfolio?
Unless you bought it separate,
I don't want to talk
too.
about it, Ron.
If you bought it separate.
Not as good. So let's put some numbers to that. So the thing that I think really got me was that first statement you made that you raised $15 million on a $300 million post for a company that didn't have a working product and revenue. If you have worked with, I ran so many incubators, like half a dozen over my career, and sat on the boards of directors and advisors of endless digital media companies. Unless you had consumers and unless you had revenues, you're not going to get venture capital money. And a lot of you have been down this road, you understand that. And then when you get the venture capital money, it's going to be 25 to 30% of your, dilution of your raise. So let's say if you're raising 15 million, if you're lucky, you're going to get a 45 million post and not 300. Because they told their limiteds that if they give you 5 million, this is what they have to charge you. This is all preset. It's not like you have a lot of negotiating room with VCs. They've told their limited investors this is how they're going to manage their money. So this is really a great opportunity. Finally, the preferred versus common shares, I think, is another huge thing that happens here, because when you think about what's happened in the digital media market, which applies to people here in the room, there was less and less capital chasing less and less deals. And unless you were, and most VCs try to get into the unicorns. And if they didn't get into a unicorn, they'll try to get into something like a unicorn or a similar Me Too unicorn time play. So by the time you get to this new set of digital media companies being funded today, there's not enough capital to go around. And so now you're actually going to the marketplace that's never been tapped into, and you're getting the best deal of the century on your shares, on your valuation of the company, and yet you're getting access to capital pre-revenue, and pre-product, in essence, in some cases. This is unheard of in my career that one can ever do. So that's why you would consider Reg A Plus and regulation crowdfunding, in addition to all these other wonderful opportunities. Now, if you're a foreign company coming to the U.S., do you see a lot of joint ventures in the U.S. from international companies trying to raise money here? I've seen more and more on that side. Basically, you can spend $500,000,
You have to be an
open up an
American
office,
company.
or do this.
You have to be an American company or Canadian company till you do a Reg
Right,
A.
so you do a joint venture, created.
No, I don't even do a joint venture. I'll just create a Nevada or Delaware company, and then whatever, because even when I was doing S1 and S11 registration statements, and I could technically do a foreign company, I would still do a Delaware or Nevada company, and then have that Delaware or Nevada company acquire the assets of the foreign
Because I've
entity.
seen like the British beer company raising money here. I've seen all sorts of Asian tech companies trying to get into the marketplace. Because if you are a technology company anywhere on planet Earth, getting access to the U.S. market and to market to the U.S. consumers is really exciting. And then getting through these platforms.
We've had inquiries from a lot of Indian companies,
Makes
especially Indian movie companies that want to have a place in the U.S.
So let's talk about the slate of films or slate of television shows or creative projects, Gene, that you're working on.
Well, a slate, it has to be over 51% owned by a Reg A company. The problem that I see with a Reg A, let's pretend that MediaShares wants to create a video game, game shares, and wants to have a racehorse, and wants to have a Broadway show, wants to have all sorts of wonderful things. If we do that, we have to own 51% of it, and so entrepreneurs are not going to want to give you 51% of their company in exchange for the capital. So anything that MediaShares does, we would need to own a majority of, and that's the problem with a Reg A. You can't be a business development company. You can't be a company that puts a little bit of money in a lot of companies. It's not legal under what.
You have to be the operating company.
You have to be the majority holder and the controller of the companies that you create. So a slate of films you would need to be a 51% owner of, which would not be necessarily impossible, because most filmmakers, when they get an investment, let's say you're going out and make a $5 million movie and a guy gives you $5 million, generally you have to give him back the $5 million and he still owns 50% of the movie. That's generally, in very rough terms, often a movie deal. So it's, if you were to do it with a Reg A, you could own 51% of a lot of movies, because that's common for the investor to own half the movie. So it might work very well in a movie deal.
And you've seen some film deals, I think, on Start Engine, right? Are you doing any of the?
No, we haven't done any
Great.
film yet, no.
No.
There is a company called Legion M that just raised $1 million under Reg CF, and they are now doing a Reg A.
For one film or for a slate?
No, their pitch was, and who knows what they end up doing, but their pitch was they're going to be doing a lot of things, virtual reality, movies. I don't know how much you can do of all those things with $1 million, but they were going to be getting into video games and movies and virtual reality. And so I think when they'll probably take that $1 million and turn it into a Regulation A, and then have a story to tell. We're going to raise $50 million or whatever amount they're going to make, and yes, then you get $50 million, you can make some video games and movies and virtual reality and all that stuff. But I think initially their fan-owned movie studio, as they call it, with their $1 million is really, the money's really made as a step deal to get their Reg A.
So Josh, what?
Platform was that? Was that yours?
No,
That was another one called WE Funder.
I like WeFunder.
Yeah.
So in terms of, Josh, in terms of the issues that arise with regulation CF and marketing those shares to the consumers, what happens there?
Well, I think, we talked about multiple tranches, but you've got to set your targets realistically. And if you don't make your target, the continued driving traffic and trying to market is going to get you into some hot water, because it's a platform meant to set a target and raise the money at that target, and that triggers the equity. If you haven't triggered, I don't know if there's a time limit, but at some point, the SEC is going to say
It's a self-inflicted time limit
Yeah, that's
that
true.
is subject to approval by the SEC.
Yep.
So, and so I try to set the bar for my clients. We were talking about somebody we mutually know this morning, and where they went wrong is they set their own limit way too high and then didn't meet it. So you want to set your
be realistic about it.
Right, be very realistic about it, and just, what I always tell my clients is, what is the minimum amount of money you can do something with, where your investors' money will still be safe. So, when you say you can raise up to $50 million, that does not mean you have to raise $50 million. But if you only raise $10,000 and then spend that investor's $10,000 and never raise a dime again, and you were not able to do anything with that $10,000, that's not a good idea either. So you want to set your minimum somewhere where your investor's capital can still be used properly and not put them at an unnecessary risk.
I mean, for the filmmakers out there, you're familiar with the idea of a minimum, maximum raise for your film. You know how much it's going to take to greenlight a film. It's similar. Don't take an investor's money and then not be able to, put your film in the can.
But you can take, in either offering a Reg CF or Regulation A, you can take the minimum and use that minimum to get more. For example, if you do a Reg CF offering and you set your minimum at $100,000 in the hopes that you're going to get $1 million, you can take that $100,000, have a closing on that first small amount, and use that money to market your offering and to do all the things necessary to get the $1 million. That's a huge advantage of having multiple closings.
And the investors can be from anywhere in the world?
Oh, yes, yeah.
Okay, so that's the interesting point, because some of the companies that I recognize here in the audience have done a really good job of taking Hollywood to kind of going global with Hollywood and getting participation from the whole world into what happens here in Hollywood. You can continue down that strategy with Regulation Crowdfunding and Regulation A+, because now you can just go back to all those consumers who are in one of the 200 countries outside of Hollywood and bring them in as investors as well. And it doesn't matter in terms of currency, taking the investments, et cetera. You guys have all that.
No, I think the currency does have to be U.S. dollars.
Has to be U.S. dollars,
Yep.
yeah, which is fine. So interestingly enough, this allows us to build global companies with this tool in the U.S., not just U.S.-based companies. It allows global companies to market themselves in the U.S. There's so many different perspectives of how you can look at this opportunity outside of just the standard. We have a project, or we have a slate of projects, or we have a little company here. We're trying to kind of ramp up to that next level.
That brings up a great point, Mariana, that a lot of companies, a lot of people from other countries want to be involved in Hollywood and in these types of offerings. And so, we get a lot of interest from India and China and places like that are
That may actually happen through these platforms. I moderated the venture capital panel yesterday, and most of the companies on that panel had some sort of involvement with China, with Asian companies in general, with European companies, in terms of both funding and distribution of the project. So it's just happening up and down the private equity scheme. So let me take a question or two from the audience, because we have this great panel with a lot of information. Go ahead, Elizabeth.
When you mentioned earlier that you can say that if somebody has 75,000, then that's their legal and includes marketing if they have a good list.
Right.
Can you all elaborate on what you think is the minimum for that good list and in social media followers, Facebook, YouTube, all that?
Plus, you wouldn't need 75,000 for your project. You would do regulation crowdfunding. How much was that? That's a lot less.
Repeat the question. Repeat the
Regulation crowdfunding, you can do anywhere from depending on how much hand-holding you need. For our firm, it's $3,000 to $9,000.
That's the big issue here. And then marketing on top of that. So then
Yeah.
her question is, let's say she's doing a regulation crowdfunding raise for one of her film projects. What would the marketing be like?
I don't know what the marketing costs would be like for that, because that's a better question for Ron, really, because you can't market outside of Ron or a platform.
I can tell you something on that.
Yeah, please do.
The company Legion M that got the $1 million they hired a PR firm in New York, and they spent $7,000 a month for 6 months, or for 3 months, excuse me, to do just the PR. That's not counting the other marketing costs. But they did get on CNBC. And if you can get on television press, and you can talk about your offering, it's a tremendous advantage. And so you're really going to need to hire a press agent to get you more sending out to everybody on your Facebook friends. You've really got to figure out a way that you're going to reach a huge audience in order for your offering to be successful. Now, if you get the $1 million, you've probably got at least several thousand investors whom you can now go back to and say, we're going to be doing a Regulation A. And that's one of the things that Start Engine likes so much, is that if you do a successful Reg CF offering, they're very interested in you continuing with the Regulation A, right? Because they see, oh, this guy knows what he's doing. He can get $1 million. I bet, let's see what we can do with the Reg A. And so it's very important that you understand that it's not just about filing the documents. It's really
I've done a big Kickstarter.
okay. Okay.
24/7.
It's 24/7. That's right.
But at least you know that you, having that experience, Kickstarter, you can now sort of parlay that into one of these raises.
Yeah, if you've had a successful Kickstarter campaign and you understand what's involved, then you should seriously consider doing a CF, because it's really a very good model to jumpstart for the Reg A.
Yes, let's take one more question.
So we have a global broadcast network, and so an instance where they come to us to do a crowdfunding campaign, and one of our situations has a global audience already prepared. But when you look at crowdfunding, there's about 500 crowdfunding. All they want you to do is make a submission of your proposal, but most of my clients want to have some level of communication or interacting. I wonder why most of them don't even have a live chat feature to discuss the merits and the likelihood of taking it out and the correlationships that can be born as a result of the relationship.
So under Reg CF, it's actually required by the regs that there is a place for an ongoing dialogue between investors or potential investors at that point and the principals of the company. And actually, by rule, the answers cannot be given. The questions, of course, anybody can ask any question any time, but you can't give the answer if you're raising capital unless it's on the platform, so that everybody gets a chance to see what the answers are. The theory is that it's the wisdom of the crowd, so everybody gets to see. So it is effectively a live chat type function for Reg CF.
But it's not private.
What's that? Oh, no, it's not private.
No, it's
That's what
public.
he said.
It has to be public. That's right.
It's on Reg G, not the regular crowdfunding.
The smaller
Reg
raises.
CF. This is all equity-based crowdfunding. We're not discussing Kickstarter, et cetera. Yeah.
Yeah, now Reg A, do you have to have a chat board?
No, do not have to.
But you'd be smart to have one anyway. If you're doing a Reg A on the platform, you'd be smart to have a forum on there where you can answer questions.
Saves time and gets more fair.
Yeah.
There's a little coaching involved. I think that would be very useful.
Yeah, that would help.
Yeah,
Any more questions?
yeah, back there.
Valerie?
I'm curious a little about the vehicle, if you're doing convertible note, if you're doing SAFE, if you're doing preferred stock, and then also in terms of strategy, if you have, say, 10 people lined up who would each put in 5,000, are you better off just giving them their convertible notes, taking your 50,000, and then going and launching something, or are you better off waiting until you do a CF so that your first day on WeFunder or on Start Engine has a $50,000 play, and then are they able to get the convertible note, or are they stuck in whatever vehicle?
Yeah, no,
Question.
okay, so if that 50,000, those 10 $5,000 investors are going to invest, it has to be at the same terms as everybody else if it's going to show as progress towards the total, right? Because otherwise, it'd be really confusing for someone else who didn't know what was really going on here. It looked like there's 50,000, but there isn't, because those people got different terms. So they get the same terms, whatever the first 50 are. Is that, you look
Yeah,
like
so
a,
strategically, which is better? Is it better for you just to take the 50 on their on convertible note terms and then use that 50 for your CF, even though then you're starting out at zero?
well, it depends on what you want to raise total. Now, you know, to be able to show momentum when you come out of the gate is very, very helpful. In fact, you know, it's surprising to me sometimes that founders who, you know, think they have big ideas, like big ideas, could be Reg A or even a Reg CF idea, big enough to raise $1 million. You know, like you know, what I was thinking is like, where's your dentist? Where's your mother? You know, somebody's got to put in some money. You can't start off with, you know, $4,000. You know, you're raising $1 million and all of a sudden you're starting off with 4 3 days later. It's like, wait a minute, that's that magical thinking again, that if I just put it there, they will come. But it doesn't work that way. So I think it is very important to take those initial investors to show the momentum, assuming that what you're trying to do is to raise a larger sum of money than the 50.
And then what vehicle do they get?
That is up to the person raising the capital. The company raising the capital gets to choose, could do any of those. We're not big fans of the SAFE. It's a philosophical thing. Actually, my partner and I really don't even agree on it. But the challenge is this: there are a couple of platforms. I think WeFunder is one of them that are requiring this convertible note thing. And basically, what it is when you invest. Let's say you put $1,000 into a deal, put the $1,000 in, you get interest. Unless and until there's a capital event, meaning another investor comes in or the company is sold, then at the option of the company, they will decide whether you are just going to earn the interest at, like, say 10% per year, or whether you're going to get the upside. Now think about it. You know what that decision is going to be right now. When it comes to that, you know, somebody else comes in and says, we're putting $10 million into this deal. Whoever's putting the $10 million in the deal is going to say, well, get these people out of here, pay them their earned interest, and that's good. But that's crazy. I mean, somebody investing in a project, a startup, taking that kind of risk for 10% isn't fair in our view. So
Not good,
we
not
really
good
kind
for
of
the investor.
Steered away. It's not
Right?
good for the
Good
investor.
for the
it's great
company, but not good for the investor.
for the people. But ultimately, you know, as a portal, if we keep doing that, I think we
See, I kind of
shortchange.
disagree with that because, yeah, it's a huge risk, and I guess it depends on the business that you're talking about. But the thing is like, for me, if you look at like a CD or a money market, what's the rate of return on that? Less than 1%.
Oh, but the go to zero risk. I mean,
Yeah.
this is a go to zero risk. When your investor comes in,
That's right.
Everybody
Not the risk of a
understands
CD.
and
That's
acknowledges it's a go to zero risk. So
No, I gotcha.
in terms of the return, but you just got to look at, like, well, it's all about, you know, what's fair, you know,
Right.
and people took that risk that they could actually lose their $1,000, and in return for that, if there is a big pop on this thing, they should sort of participate with it.
Absolutely.
Now, all that said, you know, WeFunder's very successful. They are raising capital that way. The question is whether people really know that that's what it is. And
they don't.
What's going to happen once they find out? You know,
don't.
that's the part I don't want to be a part of.
And also, I think that brings a really important question, which is when you think about raising funding for your startup venture, which is a games venture in nature, right? Or a company that's somewhat of a startup in digital media, you could go to the VCs with the right business model and to the angels, right? And then the question is, should you bring all those angels and VCs, all the Reg D investors into your Reg A platform? Preferably yes. Because if you raise 20 to 30% of your money on a Reg A platform, day one, you will look like a really hot deal, and chances are that's going to get subscribed. So yes, that's always better if you can pull it off and you have enough capital to do the filings, which, you know, are in the $10,000 range, and the marketing could be in another $10,000, $15,000. So it's not a lot of upfront capital. But if you need to raise friends and family round and then move it, then you do one of your convertible notes and then you come up. But by the time you get to regulation crowdfunding or A, you still have to try to subscribe some other investors, right? Because you really don't want to go there and first day have like no investment into the company, and first
Correct,
week
yeah.
have no investment, right? So
Kiss
that's
of
the
death.
game.
It's a
That's
kiss of
exactly-
death. It looks like something's wrong with you.
Yeah.
Like you have a disease or something.
Something's wrong with this deal, and the deal can
That's
be
right.
fantastic, but there's no vetting. And this is
right.
how it was when we raised money from the VCs into these incubation companies for years. If it wasn't a hot deal and everybody was talking about it, nobody wanted to invest money. This is very similar. This has been always the same. So it's just now translated into a public market.
I'm going to play devil's advocate literally. Venture capitalists are after one thing, a return. But that model that worked for so many years also brought a lot of resources that venture capitalists would insert into companies that they wanted to see grow. And you're going to get marketing. You're going to get a legion of marketers out there promoting what they invested in. But you're not going to get the kind of high-level resources that a VC can bring to bear, and I think you just need to bring that in mind, keep that in mind. And if you do Reg CF, and you have lots and lots of little investors, and this goes for convertible notes too. I mean, I did a company, and we raised $3 million on, tens and 20s. We had almost 50 investors. Venture capitalists do not like cap tables that have 50 investors on them. So it's something to just bear in mind if you're going on a big
Yes
trajectory.
and no. I
I can
actually
address
had
that.
Graycraft tell me, if you have a consumer venture and you've done one of these raises, either Reg A Plus or CF or Kickstarter, that actually proves your concept and we will put money in you. So they actually
Consumer
told, and if
products
you
fund.
don't do it, we won't put money into you because you don't have the uptake from the consumers.
Interesting.
It's a
So
bit-
this is like a
this
litmus
is
test for
totally-
them, right?
yeah,
If you've
yeah.
succeeded at CF, then...
Yeah.
okay.
Yeah, but
They
they're not
wanna-
dealing with
yeah.
investors, they're dealing with donors that have given donations.
Not necessarily.
No, no, it-
I'm
that's
talking
not
about,
true.
I'm talking about on Kickstarter.
No,
Yeah,
these
no.
guys are saying any crowdfunding.
No, what I'm saying is
platform.
if
It's a proof of
if you've got, let's
Yeah.
say you've got 10,000 investors on Kickstarter, they don't mind that because
No,
those
they
are
don't
all
mind Reg A
donations.
either. That's
Yeah.
that's specific. My question was
Yeah,
about
well, one reason they don't
equity.
mind is because you can have them all be one investor, like that Goldman Sachs Facebook stock deal. They walked all those investors into one
Like a special
entity, a
purpose.
special purpose vehicle, and you can do the same thing.
And if it's a proof of concept and there are millions of people globally loving this concept, why wouldn't they invest?
You,
So- yeah.
you guys just said something big, which is special purpose vehicle that a lot of the audience might not know. And I literally just wrote an article about it, and I'm sure we don't have time to delve into it now. So if you want a copy of the article on special purpose vehicles, come up to me and just send me an email, and I'll forward it to you.
So that's really a great point. I
Yeah.
think what we kind of just, I would say we put our toe in the water of everything that needs to be discussed on Regulation A Plus and crowdfunding. Had a very knowledgeable panel that's working on this daily. I want them to maybe leave you with one major point that we'd like you to remember as you maybe embark upon this journey of raising funding. So Ron, would you like to start that?
Yeah, I guess, what I've learned as a startup entrepreneur my entire career is that raising capital is probably the greatest impediment towards bringing new dreams, new ideas, technologies, and innovations into the market. And both of these sets of rules, I think, are a real game changer, maybe one of the greatest advancements for entrepreneurship in a generation. And while it's not easy, there's a lot of stuff that we're figuring out, a lot of things that we're all collectively as an industry figuring out. I think it offers just tremendous potential for all you guys that have ideas that are seeking to create the capital in order to move these from just dreams into reality. So that's super exciting. And my contact information, in case you have any questions or information, it's ron@startengine.com, and I'd be happy to answer any additional questions. Unfortunately, I got to sort of scoot out the door fairly
Thank
quickly
you.
after this. But
Yeah, thank you for that. That was great help. And then,
Same,
Dean?
same here, if you go to mediashares.com, my phone number is actually on there, and I'll be glad to talk to anybody at any time. But one thing I'd like to say in closing is that you're taking people's money, and it's a serious issue. And you're not only that, but in these cases of Reg CF and Reg A, you're taking very often money from non-accredited investors that may or may not understand what they're doing. So the SEC is trying to make it as clear as possible, making you list your offering on a portal so that people can see all the facts and figures, and that everybody sees the same facts and figures. But and the second thing is that if you're going to put on your story on the internet and expect to get any money, it has to be very clear in about 30 seconds how you're going to get the money back. We've worked with some people that their story was not very clear at first, and very often we've seen other companies not get the money that they wanted to get. They had a good company, had a good concept, but they didn't have a good, clear, concise story that anyone could instantly see the value that they were offering. So that's a very critical point.
Great. Jillian?
If you guys want to see a good Reg A ad, I would go to YouTube and look for this building called the Fair Hair Dumbbell. It's a building that's being built up in Portland, Oregon, and they have a really great Reg A ad where I think they're testing the water. So you might want to check that out. And just to piggyback off of what Jean said, investors really want to know 3 things. How much of my money do you need? How much money am I going to make? And when am I going to get it back? And you need to answer those 3 questions fairly easily without a lot of explanation.
That's what my wife asks about everything I've been. It's exactly those questions. I was like,
When do we get it back?
Okay, a lawyer gets the last word. This is all great, and it's a great opportunity for small companies to raise money themselves. This is highly regulated. You need to consult an attorney. And we do some work, you do a lot of work in this area. It's changing all the time. There are problems that need to be fixed by regulation. Everything's in flux, so don't hesitate to consult an attorney.
In my career, this has been, I think, the biggest thing that's come down the pike in terms of investment opportunities for startups all the way to later stage companies in our space. And if you are actually going to list somewhere and you live in Los Angeles, if you're from Hollywood, list on Start Engine because it's a local company and we'd like to see some growth here in Los Angeles. And thank you so much for coming here today. And if you have any more questions for our panelists, I'm sure they may stay a few minutes to answer them. Thanks again.
thank you so much.